Time is the ultimate currency, but without direction, it simply passes, carrying the purchasing power of your uninvested dollar away with it. To build lasting financial independence, you need a mechanism that captures time and forces it to multiply your effort. For millions of workers, that primary engine of wealth creation is the 401k. Demystifying this account transforms it from a confusing payroll deduction into the most powerful wealth building tool at your disposal. Decades ago, retirement was largely funded by company pensions requiring little active management from the employee. When the financial landscape shifted toward personal responsibility, the 401k emerged as the new standard. Explaining its core mechanisms reveals that it is not merely a savings account, but a highly structured, tax-advantaged investment vehicle designed specifically for long-term wealth accumulation. Understanding its architecture is the first step toward mastering your financial future. The foundational power of a traditional 401k lies in pre-tax contributions. When you elect to defer a percentage of your salary, that money is removed from your paycheck before federal and state income taxes are applied. This immediately lowers your taxable income for the year, meaning you pay less in taxes today while simultaneously funding your future. You are effectively redirecting dollars from the government directly into your own long-term portfolio. Once inside the account, those dollars experience the immense benefit of tax-deferred growth. In a standard brokerage account, you are taxed annually on dividends, interest, and capital gains, which creates a constant drag on your overall returns. Inside the protective shell of a 401k, your money grows entirely shielded from these annual taxes. Every dividend is reinvested, and every capital gain compounds without the friction of yearly tax liabilities. The true accelerator of this system is the employer match. Many companies incentivize participation by offering to match a portion of your contributions. If an employer offers a dollar for dollar match up to 5% of your salary, contributing that 5% guarantees an immediate 100% return on your investment. This is widely considered free money, representing a critical component of your total compensation package that you must actively claim. Failing to contribute enough to capture the full employer match is one of the most detrimental mistakes in personal finance. Leaving that money on the table is mathematically equivalent to declining a guaranteed salary increase. Securing the full match should always be the absolute minimum baseline for your retirement strategy. It is the most efficient way to instantly double the capital you are putting to work in the market. However, that matched money often comes with strings attached known as a vesting schedule. Employers use vesting to encourage employee retention, meaning you only gain full ownership of their matching contributions after a certain period of service. If you leave the company before becoming fully vested, you forfeit the unvested portion of the match. Understanding your specific vesting timeline is crucial when evaluating career moves and negotiating new job offers. The engine that drives these combined contributions toward massive retirement wealth is compound interest. Compounding occurs when the returns generated by your investments begin generating their own returns. Over a timeline of 20, 30, or 40 years, this exponential growth curve becomes the dominant force in your portfolio. The initial capital you contribute eventually becomes a mere fraction of your total balance, overshadowed by decades of accumulated earnings. Consider the profound impact of starting this process early. A worker who begins maximizing their contributions in their 20s allows the mathematics of compounding to do the heavy lifting. Even if they stop contributing entirely in their 40s, their portfolio will likely outpace someone who starts investing massive amounts later in life. Time in the market always defeats timing the market, making early and consistent participation the ultimate advantage. Embracing this reality shifts your entire financial perspective. The automatic deduction from your paycheck ceases to feel like a loss of immediate income and transforms into a deliberate act of paying your future self first. This structural automation removes the friction of choice. You do not have to rely on willpower to transfer funds at the end of the month. The wealth building process happens silently and continuously in the background. Yet simply funding the account is not enough. The 401k is merely an empty basket. You must actively choose the investments that go inside it. Most plans offer a curated menu of mutual funds, index funds, and target date funds. A target date fund automatically adjusts its risk profile as you approach retirement age, offering a simple, hands-off solution. For those seeking more control, building a diversified portfolio of low-cost index funds provides a powerful alternative. Your asset allocation dictates the trajectory of your growth. When retirement is decades away, a heavy concentration in equities or stocks provides the necessary aggressive growth to outpace inflation. As the withdrawal phase nears, shifting a portion of those assets into bonds provides stability and capital preservation. Balancing this risk and reward is a dynamic process that must evolve alongside your life stage and timeline. While optimizing this allocation, you must ruthlessly monitor fees. Every fund within your plan charges an expense ratio, which is the annual percentage taken to manage the fund. A difference of just 1% in fees can consume hundreds of thousands of dollars over a lifetime of investing. Prioritizing low cost, broad market index funds ensures that the maximum amount of your capital remains in your account, working for you rather than enriching fund managers. As your balance grows, you will inevitably face the psychological test of market volatility. The stock market will experience severe downturns and your portfolio balance will temporarily drop. Because your 401k is funded through consistent automated payroll deductions, you naturally employ a strategy called dollar cost averaging. When the market is down, your fixed contribution automatically buys more shares at discounted prices, accelerating your recovery when the market eventually rebounds. The automated nature of these contributions acts as a behavioral safeguard against panic. Human instinct urges us to flee when markets crash, but the structural discipline of the system forces us to keep buying. This consistency separates successful long-term investors from those who destroy their wealth by selling at the bottom. Trusting the established mechanics of the system is far more profitable than attempting to predict short-term economic fluctuations. To maximize the final outcome, your contribution rate must escalate as your career progresses. A powerful strategy is to tie contribution increases directly to your annual raises. If you receive a 4% raise, allocating half of it to your retirement permanently increases your savings rate while still allowing your take-home pay to grow. This prevents lifestyle creep from consuming your rising income and accelerates your path to financial independence. Protecting this growing asset requires strict boundaries, specifically avoiding early withdrawals or loans against the balance. Pulling money out before age 59 and a half triggers severe penalties and immediate taxation, instantly destroying a massive portion of your capital. More devastatingly, it removes those dollars from the compounding engine, permanently crippling the future growth potential of your portfolio. The account must be treated as an untouchable vault reserved exclusively for retirement. As your financial literacy deepens, you may explore the Roth 401k option offered by many modern employers. Unlike the traditional pre-tax structure, Roth contributions are made with after-tax dollars. You pay the taxes up front today, but the massive advantage is that all future growth and withdrawals in retirement are completely tax-free. Choosing between traditional and Roth depends entirely on whether you believe your tax rate is higher now or will be higher in retirement. The modern career path rarely involves staying at a single company for a lifetime, meaning your retirement strategy must be portable. When you leave an employer, you have the right to take your accumulated wealth with you. Rolling your old account into an individual retirement account, or IRA, preserves the tax advantage status of the money while often providing a much wider array of investment choices and lower fees. Never cash out the account during a job transition. The immediate tax burden and early withdrawal penalties will devastate the balance. Executing a direct rollover where the funds move directly from the old plan administrator to the new one ensures a seamless transfer without triggering any taxable events. Managing these transitions correctly ensures your capital continues compounding without interruption, regardless of where your career takes you. The echoes of those careful early choices resonate profoundly as the decades pass. The initial friction of budgeting and saving is entirely eclipsed by the staggering reality of exponential growth. What began as a modest biweekly deduction evolves into a formidable financial fortress. The silent erosion of inflation is not just defeated, it is overwhelmed by the relentless upward trajectory of a well-managed, aggressively funded retirement portfolio. As the actual retirement date approaches, the objective shifts from aggressive accumulation to strategic preservation. A massive market correction on the eve of retirement can delay your plans by years if your portfolio is overly exposed to risk. Gradually migrating a calculated percentage of your wealth from volatile stocks into stable, fixed income assets protects the capital you have spent a lifetime building, ensuring it is there when you finally need to draw from it. Eventually, the tax deferral period concludes. For traditional accounts, the government mandates required minimum distributions, forcing you to begin withdrawing a specific percentage of your balance each year once you reach a certain age. These withdrawals are taxed as ordinary income. Understanding this distribution phase is critical for managing your tax liabilities in retirement and ensuring your accumulated wealth sustains your lifestyle for the rest of your life. Crossing the threshold into retirement is the ultimate realization of this lifelong strategy. The anxiety of relying on a biweekly paycheck is replaced by the profound security of a self sustaining financial ecosystem. You are no longer trading your time for money. The money you systematically stored away is now buying back your time. This is the true definition of financial independence achieved through decades of disciplined, automated execution. The 401k is not a passive benefit to be ignored. It is the cornerstone of modern wealth building. By securing your employer match, optimizing your asset allocation, minimizing fees, and allowing compound interest to work uninterrupted, you take absolute control of your financial destiny. Implement these strategies with unwavering consistency. The Foundation Playbook is your guide, but the action is yours to take, building a legacy of lasting prosperity one paycheck at a time.